Never buy VUL. Insurance agents are just after your money. This is the worst financial mistake you'll ever make. Sounds familiar? If you've ever searched about life insurance in the Philippines, you've probably seen people raging against VUL. But here's the thing. If it's really that bad, why do so many people still buy it? Are Filipinos being scammed? Or is there something people aren't telling you? Today, we're breaking down the truth about VUL, why so many Filipinos hate it, the biggest mistakes people make when buying it, and most importantly, who actually benefits from it. Because by the end of this video, you'll know whether VUL is a trap or if it's actually the right choice for you. Let's get started. Let's get straight to the point. Why do so many Filipinos hate VUL? Why do you see so many warnings saying, never buy VUL? Well, it's not just one reason. It's a combination of things that make people feel frustrated, misled, or even cheated. And to be fair, some of these criticisms are 100% valid. High fees and commissions. One of the biggest complaints about VUL is the cost. Unlike direct investments, VUL has layers of charges, insurance fees, management fees, admin fees, the list goes on. And here's something most Filipinos don't realize. When you pay your VUL premium, a big portion of that money doesn't even go into investments. In the first few years, as much as 50 to 100% of your premium could go to fees. Meanwhile, your agent earns a fat commission up front. This is why some insurance agents aggressively push VUL. They make the most money from it compared to other types of insurance. Slow growth and underwhelming returns. Many Filipinos buy VUL thinking it's a great investment. But here's the harsh truth. VUL is not an investment-first product. Yes, part of your money is invested, but since a huge portion is eaten up by fees, it grows much slower than traditional mutual funds or UITFs. If you had just put your money in a mutual fund, 100% of it would be working for you. But with VUL, only a fraction of your premium actually gets invested. So after 10 years, when some policyholders check their fund value, they're shocked to see they barely made any money, sometimes even less than what they put in. Lack of transparency. One of the biggest problems with VUL is that many Filipinos don't fully understand what they're buying. Some think they're getting a high-growth investment, only to later find out that a big chunk of their money goes to insurance costs. They can't just withdraw their money anytime without heavy charges. The returns are not guaranteed, even if their agent made it sound that way. Unfortunately, some agents don't explain these things clearly. They focus on the investment side and downplay the insurance costs, leading to a lot of frustration later on. Mis-selling and pressure selling. Ever been approached by an agent who just wouldn't take no for an answer? Many Filipinos end up buying VUL not because they actually want it, but because they were pressured into it. Some common tactics include saying it's the best investment without explaining the costs. Using guilt-tripping tactics like, if you really love your family, you'll get this. Rushing people to sign up on the spot without giving them time to research. This kind of selling leads to a lot of regret. Many Filipinos later realize they could have gotten cheaper insurance and a better investment separately. The buy term, invest the difference argument. Financial experts often recommend BTID, buy term, invest the difference. The idea is simple. Instead of getting an expensive VUL, you buy a term insurance policy, which is much cheaper, and invest the rest of your money in mutual funds or stocks. For example, if a VUL plan costs 5,000 pesos per month, you could instead spend 1,000 pesos on term insurance for the same coverage. Invest the remaining 4,000 pesos in a mutual fund or UITF. Since 100% of your investments go into the market, instead of being reduced by VUL fees, your money grows faster. Many people prefer this setup because you get higher returns. You have more control over your investments. You avoid the high fees of VUL. And honestly, this method works for most Filipinos. But that doesn't mean VUL is completely useless. Because while it's not the best investment option, it's still an insurance product. And for some people, it actually makes sense. But who exactly benefits from VUL? That's what we'll cover in the next chapter. So, we've talked about why many Filipinos hate VUL. But let's be fair. If it was completely useless, insurance companies wouldn't still be selling it, and thousands of Filipinos wouldn't still be buying it. The truth is, while VUL is not the best choice for everyone, there are specific people who can benefit from it. The problem is that it's often sold to the wrong people. People who need lifetime insurance coverage. One of the biggest advantages of VUL is permanent life insurance. Unlike term insurance, which expires after a set period, a well-funded VUL policy can provide coverage for life, as long as you keep paying for it. This is helpful for business owners. If something happens to them, their family won't be left with debts or financial struggles. Parents of dependents with special needs. They need lifetime protection because their children will always rely on financial support. People who don't want to keep renewing term insurance. Since term insurance expires, you'd have to reapply later in life when premiums are much higher. With VUL, coverage is already locked in. People who struggle with investing on their own. A lot of Filipinos want to invest, but let's be real, many don't have the discipline or knowledge to do it properly. Some don't know how to choose the right mutual funds. Others get scared when the market drops and panic sell. Many simply don't invest at all. They just spend whatever money they have left. With VUL, the investment component is automatic. You pay your premium, and a portion of it gets invested without you having to think about it. It's not the most efficient way to invest, but for some people, having a forced investment is better than not investing at all. People who want insurance with cash value. With term insurance, if you don't die within the coverage period, you get nothing. It's purely a safety net. But with VUL, even if you don't use the insurance benefit, your policy builds a cash value over time. This means you can withdraw some money in the future. You can use it as emergency funds, but with limitations. You can let it grow and use it later in life. Of course, this only works if you keep your policy long enough for the cash value to actually grow. If you surrender early, you'll likely lose money. People who want a set-and-forget financial plan. Some people don't want to handle separate insurance and investment plans. They just want one product that covers both. For them, VUL is attractive because it's convenient. One payment, two benefits. It's structured. They don't have to actively manage investments. It's long-term. They just keep paying, and it takes care of itself. It's not the most cost-effective way to grow wealth. But for people who prefer simplicity over optimization, VUL can make sense. People who want a tool for estate planning. For high net worth individuals, VUL is often used as an estate planning tool. The insurance payout is tax-free, ensuring that heirs receive a lump sum without dealing with estate taxes. It provides liquidity, meaning when the policyholder dies, their family immediately gets cash without needing to sell assets. Some policies are structured in a way that maximizes inheritance while minimizing taxes. This isn't relevant for the average Filipino, but for the wealthy, VUL plays an important role in financial planning. But here's the catch. Just because VUL can work for some people doesn't mean it's right for you. So before you sign up, you need to understand the reality of owning a VUL policy. Because if you don't, you might regret it later. That's exactly what we'll talk about in the next chapter. At this point, we've seen both sides of the argument. Why so many Filipinos hate VUL, and who might actually benefit from it. But before you decide, there's one more thing you need to know. The reality of owning a VUL policy. Because what most people don't realize is that even if VUL sounds good on paper, actually maintaining it is a different story. Let's talk about the common struggles VUL policyholders face, so you can decide whether this is really something you're ready for. You need to pay for a long time, or you risk losing money. One of the biggest mistakes people make is thinking they can just try VUL for a few years and see how it goes. But here's the problem. VUL is a long-term commitment. In the first 5 years, the fees are so high that your investment barely grows. If you surrender early, you could end up getting back less than what you paid. For most VUL policies, you need to keep paying for at least 10 to 20 years to really see the benefits. That's why many people who get a VUL end up frustrated. They realize too late that it's not something you can just cancel without losses. your insurance costs increase over time. Many Filipinos don't realize this, but the insurance cost inside a VUL policy goes up as you get older. When you're young, the fees are low, so your investment can grow. But as you age, the insurance charges increase, and they're automatically deducted from your fund value. If your investments don't perform well, these fees could eat up your savings, and your policy might even lapse. This is one of the biggest risks of VUL that most agents don't talk about. If you don't fund your policy properly, you could reach a point where your cash value isn't enough to cover the rising insurance costs, forcing you to put in more money or lose your coverage altogether. Your investments have no guarantees. Some Filipinos are sold VUL with the promise that their investments will grow. But here's the reality. Your money is invested in the stock market or bonds, which means returns are not guaranteed. If the market crashes, your VUL fund value drops too. Unlike other insurance products with guaranteed cash benefits, VUL relies on market performance, meaning you could end up with less than you expected. And remember, this is happening while your insurance charges are increasing. So if your investments don't perform well, your policy could collapse even faster. Surrendering your policy means big losses. What if you suddenly need cash and want to withdraw your VUL money? Unfortunately, most policies have heavy surrender charges if you cancel early. In the first 5 years, your surrender value might be almost zero. Even after 10 years, you might still get back less than what you put in. Unlike mutual funds, where you can withdraw anytime without penalties, VUL locks you in for the long term. This is why many Filipinos regret buying VUL. When they need money the most, they realize they can't access their savings without suffering huge losses. Many policyholders end up letting their VUL lapse. Because of all these challenges, high fees, rising costs, and long-term payments, a huge percentage of Filipinos who buy VUL end up letting their policies lapse. Some realize they can't afford the payments anymore. Others get frustrated with the slow growth and just stop paying. Some don't even know their policy is in danger of lapsing until it's too late. And what happens when a policy lapses? You lose both your insurance coverage and your investment. All those years of paying gone. Now that we've covered the risks, it's time to answer the final and most important question. Should you get a VUL? Or is there a better alternative? That's what we'll discuss in the next chapter. So now, we've uncovered the truth about VUL. Why many Filipinos hate it. Who actually benefits from it. The harsh realities most policyholders don't realize until it's too late. Now, we come to the most important question. Is VUL the right choice for you? Or is there a better alternative? The answer depends on your financial goals, your discipline, and your understanding of how VUL works. So let's break it down. Option 1. VUL, the right choice for some, but not all. VUL can work for certain people, but only if you're committed to paying premiums for the long term, 10 to 20 years. You want lifetime insurance coverage with an investment component. You prefer a set-and-forget financial plan instead of managing separate investments. You understand that returns are not guaranteed and insurance charges increase over time. You're getting the policy from a trusted insurance company with a competent agent. If these points describe you, then VUL might fit your needs. Just make sure you ask your agent for a detailed breakdown of fees before committing. Choose a policy with a fund allocation that aligns with your risk appetite, equity, balanced, or bond funds. Have a financial plan in place to ensure you can sustain the payments long term. But if you're not 100% confident about these conditions, you may want to explore other options. Option 2. BTID. A smarter alternative for many Filipinos? Many financial advisors suggest an alternative strategy called by term, invest the difference, BTID. Instead of getting a VUL, buy a term life insurance policy. It's cheaper than VUL and provides pure protection. Invest the money you would have paid for VUL in a mutual fund, UITF, or stocks. Keep control over your investments while getting the insurance coverage you need. With BTID, it is more cost-effective. Term insurance costs much less than VUL, so you can invest more. Higher potential returns. Mutual funds and stocks generally offer better long-term growth than VUL investments. Flexibility. You can withdraw your investments anytime without heavy surrender fees. However, BTID only works if you're disciplined enough to actually invest the difference. If you just spend the extra money instead of investing it, you could end up worse off. Option 3. Traditional whole life insurance. A middle ground? If you want lifelong coverage but don't want the risks of VUL, another option is whole life insurance. It provides guaranteed cash benefits, unlike VUL's market-based returns. It has fixed premiums, meaning the cost won't suddenly increase. It still builds a cash value over time, but with more stability. However, whole life insurance tends to be more expensive than term insurance, so it's only worth it if you really need lifelong protection. At the end of the day, the best financial decision is the one that truly serves your needs and goals. Some people swear by VUL, while others avoid it completely. But one thing is clear: many Filipinos buy financial products without fully understanding them, only to regret their decision later. So before you commit to anything, ask yourself, do I fully understand what I'm getting into? Is this the best way to protect my family and grow my wealth? Am I choosing this because it aligns with my goals, or because someone convinced me? Because the worst financial mistake isn't just losing money, it's making a decision you don't understand. And remember, you don't have to rush. Take the time to study your options, ask the right questions, and choose a financial strategy that actually works for you. At the end of the day, it's not about whether you choose VUL, BTID, or whole life insurance. It's about making a decision you won't regret. What's your take on VUL? Let's have an open discussion in the comments. Do you think it's worth it, or do you prefer other options? If you found this video helpful, consider liking and subscribing so we can keep making content that helps Filipinos make smarter financial decisions. This is Thrifty Finance Vision PH, and I'll see you in the next video.